Google searches are spiking around the 1987 stock market crash, also known as Black Monday. Headlines are dramatic, and Wall Street is on edge. But what's really going on? And more importantly, how does this affect you, especially if you're a young person trying to get your money right? Let's break it all down. Last week, President Donald Trump announced aggressive new tariffs aimed at reducing the U.S. trade deficit. As a result, the stock market had its worst sell-off since 2020. That panic triggered a wave of online searches for Black Monday, the infamous stock market crash of 1987. People are now worried we could see something similar. But let's pause and understand what actually happened back then. Black Monday wasn't caused by one thing. It was a perfect storm. Rising interest rates, trade deficit fears, inflation concerns, and a declining dollar all played a part. The crash marked the end of a bull market that had lasted since August 1982. A bull market refers to stock prices rising 20% or more from a previous low over a sustained period. Generally, bull markets occurred during a growing or strong economy, a stable gross domestic product, soaring corporate profits, and low unemployment rates. On Black Monday, the stock market opened with an imbalance of demand. More stocks were being sold than bought. According to the Federal Reserve, the New York Stock Exchange lost more than $500 billion in market capitalization, the largest loss since the beginning of World War I in 1914. The combination of various factors like rising global interest rates, a U.S. trade deficit, a declining dollar, inflation concerns, and more led to the collapse of the market. The Federal Reserve stated margin calls, program trading, and difficulty obtaining reliable information added to the severity of the market collapse. Now you may be wondering what margin call is. When investors enter contracts in futures markets, they're required to post a portion of the contract's value into an account with a broker. This value is referred to as a margin. If the value of a contract decreases, a broker can request the investor to add additional funds to their margin account. Margin calls are issued when the balance in the account dips below the maintenance requirement. The sharp price movement in futures contracts resulted in end-of-day margin calls becoming 10 times the average size on Black Monday. Investors had to meet these calls by the morning of October 20th. Many institutions didn't have the cash to fulfill the requirement and relied on banks for loans. Banks became concerned about margin calls exceeding lending limits, but still fulfilled them by extending credit. By doing so, banks prevented trading from becoming severely disrupted. Let's also discuss what program trading is. It just refers to computers being set up to quickly trade large numbers of stocks when a particular stock index contains certain conditions. In 1987, there were two program trades: portfolio insurance and index arbitrage. Portfolio insurance is guaranteed to limit the losses investors might face in a declining market. Under this program, computer models were designed to calculate optimal stock-to-cash ratios at various market prices. Many portfolio insurers conduct their transactions in the futures market and trade in batches. So when the market began to crash on Black Monday, portfolio insurance algorithms triggered more stock sales, creating a cycle. So it wasn't just fear. It was fear amplified by tech and leverage, of which rumors did not help at all. Now fast forward to today. Trump's latest tariffs hit all foreign imports. These tariffs, which include a 10% levy on all foreign imports and higher rates for countries with substantial trade deficits with the U.S., have led to increased production costs and consumer prices. Economists warn that such measures could trigger stagflation, characterized by stagnant growth and rising inflation. Let's look at the implication of the president's decision. In the short term, there have been instances where tariffs contributed to a decrease in crude oil prices, potentially leading to lower gas prices. This could benefit young individuals who rely on personal transportation. Tariffs often lead to higher prices for imported goods, such as electronics, clothing, and everyday essentials. For young people, who may have limited financial resources, this can strain budgets and reduce purchasing power. Industries affected by tariffs, including manufacturing and retail, may experience slowdowns, potentially leading to reduced hiring or job cuts. Young individuals entering the workforce or seeking part-time employment could find fewer opportunities. Economic downturns associated with tariffs can lead to cuts in public funding for education, potentially resulting in increased tuition fees. This can make higher education less accessible for young people. But It might protect American jobs in certain industries and could reduce dependency on foreign goods. If you're young and watching this, you might be thinking, what does this mean for me? Well, here's the good news. Volatility creates opportunity, especially for those with a long-term mindset. Here are a few recommended smart choices you might want to consider. 1. Stocks are on sale. When markets fall, many quality companies see their stock prices drop, not because the business is failing, but because of overall market fear. This gives you a chance to 1. Buy into strong companies at a discounted price. And 2. Build a portfolio when prices are low and benefit from future growth as the market recovers. For instance, if you had bought into solid tech stocks after the 2020 crash, you could have seen significant gains during the recovery. 2. Lower barrier to entry. You don't need a lot of money to get started. With platforms like Robinhood, Webull, SoFi, and Fidelity, you can buy fractional shares of big companies. There's more free information and education available than ever, making it easier to learn and start with low risk. 3. Long-term advantage. Young investors have something older ones don't: time. Volatility and downturns are part of the cycle, but if you're investing with a long-term view, 5 to 10 plus years, the ups and downs often average out to solid returns. 4. Learning opportunity. Volatility is where you learn the most about market behavior. Even if you're paper trading, not using real money, that is. Now is a great time to observe trends, reactions to news, and how different sectors behave. This could actually be the best time for you to build a portfolio, gain experience, and position yourself for long-term wealth, even if it feels like chaos now. Some risks to keep in mind. Short-term trading can be risky if you don't have a strategy or emotional control. Tariff news and recession fears can lead to fake rallies and sudden crashes. Stick to a plan. Know your risk tolerance, do your research, and don't invest money you can't afford to lose. So if you're new to investing or just watching the news wondering what it all means, don't panic. Learn, prepare, and maybe even profit. If you want more beginner-friendly tips on trading, side hustles, or building your online income, hit that subscribe button and drop a comment below. And remember, market crashes make headlines, but smart moves during those crashes make millionaires. See you in the next one.